Hi, folks. My name is Mike Zlatnik. I'm a fund manager for Tempo Opportunity Fund and Tempo Growth Fund. And we're doing this presentation. It's a refresher on investment quadrants, risk-adjusted return, and portfolio building blocks. So I appreciate your time in advance. If you've listened to this presentation in the past, this has some new elements, and hope you enjoy this presentation. If this is your first time, hopefully you'll find it fun. I appreciate your feedback and any comments afterwards. Yeah, disclaimer. So this is for informational and educational purposes only. We are not offering to sell anything at all, nor offering any kind of advice. Please consult with your CPA or attorney professional. If you're interested in one of our funds or family of funds, please request the private placement memorandum for each fund, as that's the formal offering document to accredited investors only. Appreciate your time in advance, and hope you enjoy the show. Just a couple of words about me, known as the Big Mike. Big guy, 6'4", and a little bit on the heavy side. So the name stuck, and kind of using this as a brand. Married over 21 years to my lovely wife, and have 4 kids and a cat, the 5th child. Live in Brooklyn, New York, and I'm a CEO of TF Management Group. It's a real estate, private equity, and fund management company, and been a fund manager since 2009. Family of funds, or 2 flagship funds. It's Tempo Opportunity Fund is Income and Growth Fund, and Tempo Growth Fund is our growth fund. In a past career in software, retired holding multiple senior positions, almost 15 years in software. Kind of enjoyed it, but found that my passion, my calling is real estate, something that I love, something I'm good at. And so that's why I'm doing real estate. So long story short, I have a book out called How to Choose a Smart Real Estate Investment Fund. And I run a podcast called Big Mike Fund Podcast. We invest in broad range of assets and sponsors around the countries. Our funds are basically funds of funds. We diversify among many dimensions, and sort of some areas of specialty, short-term bridge funding, hard money loans, as well as long-term equity investments, predictable cash flow, and on the other side, value-driven appreciation. Many sectors like self-storage, multifamily, conversion of hotels to affordable housing, and so on and so forth. Why people invest with us? Experience. Been doing this since 2009, have a strong track record. Diversification. That's one of the key benefits of investing with us. Our funds are broadly diversified among many sponsors, regions, locations, debt and equity, and so on. And we spread the risk among many assets and provide you with a single access point into a diversified portfolio. Best access point, many deals we invest in are not available to public, and by going through us, you're getting access into a great portfolio of assets. Business philosophy, our investors come first. We pride ourselves on white glove service. Transparency, we use reputable SEC counsel, green fund administrator, and a large audit firm. We communicate frequently through emails, online portal, quarterly statements, Zoom calls, and so on and so forth. Now let's talk about quadrants. So what are these quadrants? This is an educational concept to help you understand kind of any investment that comes across my desk. I look at it and I decide, is this a quadrant 1 deal, a quadrant 2 deal, a 3, or a 4? So quadrant 1 and 2, what I call them investment grade. They're deals with low to moderate risk, well understood risk, and well understood risk mitigation strategy. And quadrant 1 and 3 are cash flow focused, and quadrant 2 and 4 are growth focused. And quadrants 3 and 4 are speculative quadrants. So the way to think about this is that you could every deal that's out there will fall into one of these quadrants. Some of them are borderline between the 2 quadrants, but still you could make a decision where a deal is, where is its primary location. And this presentation will teach you how to decide what quadrant a deal is at approximately, and then how to adjust for risk. It's all about the risk-adjusted return, not the top line. So these projects have what is known as a projected or target ROI. It's the top line return. So if you invest in a deal and it looks like a quadrant one deal, most likely its target return will be between 8 and 14%. Again, it varies with market conditions quite a bit, location, obviously, type of deal, but these are approximate numbers. Quadrant two deals, it's 10 to 16 target. Quadrant three, again, these deals are much more speculative. So quadrant three has a higher degree of risk, and its target 12 to 22%. Broader range. Why broader range? Because the volatility is higher with speculative deals. And then quadrant four, it's a speculative growth quadrant, and its target return 15 to 25%. It's basically, there's a lot of risk associated with investing in these type of deals, and the returns better be high, otherwise why take the risk? That's the basic concept here. So all projects have risks, and cannot understate this. Too many people in today's environment ignore risks. They're just chasing the yield. And when you're chasing the yield or top line returns only without understanding the capital structure of the deal, the sponsor, the underlying dynamics, the capital stack, you may wind up losing all your money because you're chasing high risk deals. So risk adjusted return is the methodology how to understand and adjust for risk. But here are examples of risk. There are many. I'm listing a few. There are many more risks on different projects. Please understand that all projects have risks. Even investment grade projects have risks. Just the speculative quadrants risk is just higher substantially than investment grade risk. And that's what this presentation is all about, adjusting for risk. Here's a basic formula. So how do you compute risk-adjusted return? It's a holy grail of investing. You really want to invest with consideration for risk, not just consideration for the return. And the basic formula is risk-adjusted return equals to the projected return minus loss reserves or risk discount associated with a given investment and its risk profile. So loss reserves or risk discount for investment grade is lower than the loss reserves and the risk adjustment than the speculative grade projects for obvious reasons. So here's a general high-level guidance, and it changes quite a bit from a project to a project. Please understand, even quadrant one risk can fail completely, and a quadrant four deal, which is sort of a highest risk, can succeed hugely. So there's nothing wrong with any specific quadrant or any specific deal. It's more of the risk adjustment is different. So the downside protection has to be there for quadrant one deal and also quadrant two deals. Both are investment grade deals. Is it a first lien loan? Is it lightly leveraged syndication with a good cash flow? If the loan is low investment to value ratio? All those characteristics are important. We'll cover them in just a little bit. General loss reserves for quadrant one and two deals, investment grade deals, is between 1 and 3% under normal circumstances. When volatility increases and uncertainty increases, the loss reserve has to increase too. And these projects should be able to withstand substantial stress conditions. Speculative grade projects, loss reserves are much, much higher. Here's a broad range between 5 and 20%, and it could be even higher. With the average under the current market conditions, and things change, in my view, on average, is between 6 to 8%. Some deals are so risky that their risk-adjusted return is negative. In other words, you take a top line, you adjust for risk, and you're projecting to lose money on the deal because how risky it is. So market condition, again, project-specific risk make a massive difference. So here are the quadrants again, but risk-adjusted. If you look at quadrant one, the risk-adjusted discount is 1%. Again, this is an example. This is educational content. it can vary. There are quadrant one deals that would need a higher loss reserve than this, and there are some quadrant one deals that would require less loss reserves. But in general, loss reserves are needed on every investment. So I'm discounting 1%, so the range from 18 to 14 drops down to 7 to 13. Similarly, for quadrant two, the loss reserve discount is 2%, and the target adjusts accordingly from 8 to 16 down, sorry, from 10 to 16 down to 8 to 14. For quadrant 3 and 4, as you can see, risk adjustment is substantially higher. I'm using 6% for quadrant 3 and 7% for quadrant 4. And as you can see, risk-adjusted return in quadrant 4 and quadrant 3 has substantially bigger range because, again, they're much more speculative, and the risk discount is higher. So you could wind up making a better target return in quadrant 1, 2 deals than quadrant 3 and 4 deals with taking lesser risk. It's a possibility. On the other side, you could wind up with substantially higher returns in quadrant 3 and 4 deals with higher level of risk if you pick and choose the right projects with the right sponsors. But conceptually, absolutely discount whatever the top line you see on every investment, every fund, every syndication. You got to put it in the quadrant, and you have to adjust for risk. Once you adjust for risk, you're setting your expectations more conservatively. It can help you understand the more likely outcome of a specific project. Please realize that returns on projects depend on many variables. Even the best and smartest sponsors could have issues, and even pretty bad sponsors and fund managers can succeed if the market condition is great. So there's a lot of variance to this. That's why it's really important to pick and choose who you invest with and what kind of projects. Okay, portfolio built to last. So the way to build a portfolio to last, you got to start with goals, then create allocation model leveraging quadrants, then assemble your portfolio with portfolio building blocks such as fund syndication, partnerships, individual deals. Again, all I'm talking about is real estate, not going into stock market or other investments. This is all about real estate. And then monitor as you go. Diversification is sort of the risk mitigation strategy number one. If you diversify well, in general, you'll be able to manage risks a whole lot better than a focused portfolio. Now, a focused portfolio can outperform a diversified portfolio if the focus assets do better. But a focused portfolio can substantially underperform a diversified portfolio if there's a problem with the investments that the portfolio is concentrated on. So here's the oldest wooden roller coaster in Brooklyn, New York. It's got a lot of frills. You get to enjoy ups and downs. The diversified portfolio should have a lot more smooth sailing. No guarantees. There's still some volatility. Just volatility should be lower on a diversified portfolio. So building a portfolio for lower volatility and higher predictability. Generally speaking, on the bottom of the well-diversified portfolio are diversified funds with multiple strategies and broad diversification. So more capital is committed to that than the above syndications and funds. Then above that, there are single strategy funds. So here are some examples. Single strategy fund could be self-storage fund with that focus, or a fund that focuses on multifamily, or a fund that focuses on office. Those are focused strategies, while diversified is a fund that spreads risk among many strategies. And above that, you see individual syndications. So it's a one-off deals, which have even a higher degree of risk and concentration. And then finally, individual deals that are partnerships or just individual property ownership. So building a portfolio this way spreads the risk and allocates capital in a more predictable manner. So just an educational methodology on what a diversification pyramid looks like. So here's an example of allocation using quadrants. Depending on your own risk profile, depending on your own goals, depending on your own comfort, you may decide to put more money in quadrant 1 than quadrant 2, and then quadrant 3, then quadrant 4. Or if your risk tolerance is high and you have absolutely comfort level taking more risk, you could decide to reverse and put more money in more speculative quadrants. Completely up to you. But here's an example. So if you decide to put $3 million in quadrant 1, you may decide that on the bottom of that diversification pyramid, you would invest um, if you're allocating 3 million into income portfolio and 2 million into growth portfolio, and you're deciding to allocate 2.5 million in the quadrant 1 and 500,000 into quadrant 3 for the income side, and then for the growth side, you're taking 2 million and you're allocating 1.5 into quadrant 2 and 500,000 into quadrant 4, then essentially you have to solve the next problem. Is you have to break the investment into chunks. How much do you put in diversified funds, and how much you put in the single strategy fund, and how much do you put into single assets or syndications? So again, here examples, you're trying to build a pyramid bigger on the bottom and kind of smaller on top. That way it's more sturdy, like it works in real world. The same concept applies in the investment portfolio allocation theory. So let's now look at the examples of deals that fall into different quadrants. And we'll dive over a series of slides into details on these quadrants. So first, lien performing mortgages at the low investment to value ratio. It's a clear example of quadrant 1 deal. And we'll go through examples. Turnkey houses may be quadrant 1 deals. Generally speaking, they have cheap long-term debt finance by Fannie and Freddie. Basically, they are leveraged, so there's some level of risk related to the leverage, but the debt is cheap and it's long-term. And as long as cash flow can be sustained on a portfolio of turnkey houses, this strategy could work. Low leverage is also a good indicator. So what do I mean by low leverage? 75% or less. I would love to see lower than 75%, but in today's conditions, on a turnkey, you want to get as much cheap money as you can. 75% works. For first lien mortgages, I like to be below 70% leverage. We'll talk about this in a minute. Cash flow syndications with low leverage. So if you invest in a multifamily in this conservative leverage of cheap bank financing with good debt service coverage ratio, substantial cash reserves, it falls into quadrant 1 deal. I like those as a consideration too. Diversified funds with most assets in quadrant 1. So when it comes to funds and diversification, depending on what's in the fund, that's how you assign a quadrant. Sometimes a fund spreads multiple quadrants. Quadrant 2 deal. So quadrant 2 is a growth quadrant, and first lien non-performing mortgages at the low LTV fall into this quadrant. So that strategy is fairly straightforward. The low LTV or ITV, investment to value ratio, or loan to value ratio, creates a downside protection. And then the default interest, it creates the upside. So we'll talk about them in a minute. Value add syndication with break even cash flow. In other words, you take, instead of cash flow syndication, they have value add work. And they basically at least break even through the value add part of the project. They have substantial reserves. They can withstand some fluctuations, and they're prepared because of the value add. As units renovate and they come in the market with higher rents, then the deals will shift from quadrant 2 to quadrant 1. The other key message here is that the deals can shift from one quadrant to another over time, and they usually do. So as value add strategy is executed and the deal is less risky, it will shift to a better quadrant over time. The quadrant 3 deal example, so second lien mortgages, cash flow syndications with high leverage. So we can have a deal that has 85% leverage. It's too much. That's why it's quadrant 2. Again, if you're second lien, and regardless of the combined LTV, if it's a second lien loan in general, it's a quadrant 3. It's a quadrant 3 deal. And then mezzanine debt, preferred equity could all be in this quadrant 3 deal. It really depends on the capital stack and the seniority and how much first lien mortgage there is. But in general, mezz debt and preferred equity can be a quadrant 3 deal. And diversified funds with most assets falling into quadrant 3 deal is also they fall into this quadrant. And quadrant 4, so quadrant 4 generally speculative grade, growth quadrant. And this quadrant encompasses everything in the development, redevelopment, land speculation, and so on and so forth. Heavy value add syndications with negative cash flow also fall here. So any kind of a deal where it's bleeding cash substantially while it's executing value add strategy, or not generating cash at all and operating at a substantial loss, they're all speculative in nature, because they are hoping and speculating that the return will come on the back end from a sale of the asset. And there are greatest type areas and greatest strategies. Still, these deals are speculative in nature because of their structure. Now let's go through some examples of quadrant 1 and other quadrant deals. So this is a quadrant 1 deal, hard money loan at below 70% LTV. LTV stands for loan to value ratio. Ideally below 65, strong track record of the borrower, clear value add plan and exit, generally 12 months or less. And then the interest rate in today's market, 8 to 10%. It can be lower and higher depending on factors, but $70,000 loan on a property that's worth 100,000 is an example. Quadrant 1 deal example, quality cash flow syndication, similar funds. So it could be broad range of type of deals, multifamily, self-storage, office, industrial. Obviously, trends make a difference. So we live in a post-COVID world, and certain sectors have taken it on the chin. Office has a high degree of uncertainty because we still don't know how the office will recover. It really depends on location. And so here, let's assume at the moment it's a well-shielded office from the COVID impacts. So industrial is doing well generally now. Multifamily and self-storage is doing well. So it's just the type. Light to moderate renovations, some expansion. So these type of deals should not be heavy lifts, heavy construction. And then improve asset management. So lease up, additional services, better collections, tenant mix. These type of value add strategies are more applicable than super heavy construction. Cash flow on these type of deals should start somewhere, should not be zero for sure. There's no right or wrong. In general, I like to see cash flow of 6% plus year one if there is some value add, and improving over time, getting into 8 to 12% range, or kind of an average between 2 to 5 years. So I can tolerate a little bit lower cash flow from the start as long as there's a pretty good path to better cash flow. If they're cash flowing less than 6%, they can still be good type of deals, except for they may not fall into quadrant 1 because they're more kind of low income, more growth type of deals that fall into quadrant 2. Moderate debt leverage, so 60 to 75% LTV. And if you're on equity, you definitely want to see no more than 75% leverage. Highly leveraged deals are more speculative in nature. They would not belong in quadrant 1. Light sponsor fees, again, it all kind of leads to the right risk-adjusted return. So we want to see alignment between the sponsor and the investors. 1% asset acquisition fee, 1% asset management fee. Those are good. Can they be high? Yes, they can. There's no right or wrong. The range, but it has to be a reasonable range. Between 1 and 2% is pretty good. Possibly a little bit high under some circumstances. What I don't want to see is deals with the high fees for the sponsor up front, and that misaligns the interest. Fair preferred return and a split. So the pref, generally here 7 to 10%. It can be lower. I've seen deals with 6%, and they're perfectly fine. Just an approximate range. And then the performance split above the pref should be somewhere between 60-40, 70-30, and 80-20. Again, the 60, 70, and 30 should be going to investors, and 20, 30, and 40 to the manager, not the other way around. And then high quality sponsor, high integrity, high track record, good communications, and so on. Quadrant 2 deals, non-performing notes at the low LTV, moderate value add syndications in similar funds that break even on the cash flow through the value add phase. So first lien non-performing notes at low LTV. As you can see, LTV has to be lower on non-performing paper than performing because you're taking more risk investing in the non-performing notes. High default interest rate. You want to see upside, pretty substantial upside because you're investing in defaulted paper. If you're not collecting default interest while you're investing into that, you're better off with performing. Again, quality collateral, strong sponsor experience at foreclosure and workouts. Value add syndication, similar to the cash flow syndication for Quadrant 1. The deals that have last cash flow or they break even through the value add phase kind of fall into Quadrant 2. So, and they generally need more liquidity to withstand value add phase delays and other construction issues. Here's an example of Quadrant 2, distressed commercial debt or debt fund, low investment to value ratio. So here's an example. First example of NPL where the collateral 30 to 35 million and then the loan is 16.5 million. That creates a pretty low LTV and creates downside protection. And the upside comes from the default interest rate. So these are the type of examples that fall into Quadrant 2 on the distressed debt side. Quadrant 3 examples, second lien performing notes and heavily leveraged syndications. So here's an example of a second lien note where the first plus second combined, which is known CLTV, combined loan to value ratio, does not exceed 75%. If it's a 75%, in my view, it's too risky. Now you can still do it, and there'll still be in Quadrant 3, but the level of risk reward just very difficult to justify making a loan above that value and still make it work on a risk adjusted basis. Has to be high interest rate, generally 15% plus. Can they be low? Yes, if some de-risking takes place. Can it be higher? Difficult to push it beyond above 24%. Usually you could ask for some equity kicker instead of a high interest rate as a way to capture some more upside if things go well. A good quality borrower is important. Obviously, track record, experience, clear exit strategy. Here's an example. Say the first lien mortgage is 300,000, and you're making a second lien for 80,000, and the asset value is 600,000. You combine first plus second is still pretty conservative, and you can make this loan feeling pretty good about it. The fact that it's a second lien loan is still Quadrant 3. Heavily leveraged syndications, typically the loan to cost could be 75 to 90%. The leverage is high, and the consequence of that, there's more risk. And then debt service coverage ratio is important too. Does the deal support debt service? If the deal doesn't support debt service, then the deal is pretty speculative. So can you do a deal in Quadrant 3 that has 90% leverage and debt service coverage ratio below these numbers? Yes, but you gotta have a higher risk-adjusted return on them because the risk profile changes and you're taking more risk on these type of deals. So at the end of the day, you have to assess what would happen if things run into problem. What's your possibility of a complete loss of capital if the deal runs into trouble, and what's your upside? Are you capturing enough upside if a deal goes great? So that's the most important consideration, because some of the speculative deals will go bad. It just happens, and you have to be prepared to write the entire investment off if a speculative deal goes bad. But you got to capture the upside on other speculative deals when they go great. That's the key consideration to get the right risk-adjusted return. Quadrant 4 deals examples, again, heavily value-add deals, development, redevelopment, land speculation. They all present a ton of speculation, and they're all Quadrant 4 deals. And they have negative cash flow on value-add deals. Example, below 50% occupancy on multifamily repositioning of the asset. Um, One of the recent hot sectors has been repositioning old hotels to affordable multifamily housing. We invest in many of these deals with the right risk-adjusted return profile. So the point is, you could do that. You can invest in those deals if they make great economic sense. There's nothing wrong with the quadrant 4, as long as the upside that you have on these deals and the economics look strong on the risk-adjusted basis, and the risk is well understood and mitigated with an experienced operator and a sponsor. So development, redevelopment, ground up development, anything multifamily, self-storage, conversions, they all quadrant 4 deals. Land speculation, also quadrant 4, obviously. Here's an example of a quadrant 4 deal, heavy value add multifamily. Here's here's a situation where the budget, renovation budget, is greater than the purchase price. When you look at that, it's pretty obvious. If the renovation budget is 10-15% of the purchase price, then it could be a much better quadrant. But when you're spending 12 million on renovation and you bought it for 8.5, for sure it's going to be a quadrant 4 deal. It's a massive redevelopment and repositioning. So here's an example, all in 25 million, a little more, and then the debt is 20 million and the equity is 5. So this is pretty substantial leverage. It's 80% leverage, and the deal itself is heavy lifting construction. So the deal is quadrant 4 written all over it, and it's got a negative cash flow as occupancy is below 50%. All those things make it look like a quadrant 4 deal. So it's a repositioning of the asset. They have to complete renovation and potentially go through a different tenant mix and charge higher rents, substantially higher rents. So the value add here better be pretty high. So essentially, the 25 million is all in, and the projected target sale price over 40 million. That's a big enough upside to sort of consider the project. So the return here, if the deal goes reasonably well, you could get $15 million plus of the equity upside on a $5 million investment. It's a very substantial upside, and the deal projected to LP returns over 30%. When the deal has that high risk, you got to have very high upside. If the deal is structured so that your target return is 12 to 14 and you're taking massive level of risk, it doesn't make any sense, because the loss reserves here is probably 8 to 10% on this deal. So 30% target has to be watered down into low 20s and possibly even more. So this is the general kind of approach to quadrant 4 deals. So a couple of words about our family of funds. The Tempo Growth Fund is is purely focused on growth, and it is mixed between quadrant 2 and quadrant 4 deals. This fund does not concern itself at all with income producing assets. It's all about growth, risk-adjusted growth. So it's closed-ended, simply means we're raising capital all 2020 and 2021, and then we'll close in early 2022 to new subscriptions. At that point, the money goes to work on multiple projects, and we obviously invest as we go. So the last investment is going to be in 2022, but we are raising capital, investing on projects as we go along. It's well diversified. Target annual return is 12 to 18%. As you can see, it is a substantial target, but you gotta adjust for risk, because there's risk. It's quadrant 2 and 4 deal. And mixing them up, you have to feel comfortable that the risk-adjusted return is a good number. Like anybody else, including our own funds, you as an investor should always adjust for risk. So we're not any better than anyone else. We believe we have good funds with a great risk-adjusted return, but as an investor, you always have to think that even the best operators could have issues and adjust for risk. So again, 12 to 18 target. It's tax efficient in two ways: that it passes through a lot of depreciation benefits, and most of the return will come on the back end in the form of capital gains. So it's the most efficient from a tax perspective. It's 5 to 7 year time horizon. Some capital will come back a whole lot earlier, because different deals have different life cycles. We have deals will cycle through in 2 years, 3 years, and some may take full 5, 6 years. That's why the projection for the fund 5 to 7 year time horizon. It is IRA friendly. We don't use leverage on a fund level. And then the fund has a genuine institutional level waterfall. We pay investors 8% cumulative preferred return. It accumulates, obviously, in early years. There are no distributions because it's a growth fund, but the pref has to be caught up. After the full pref is caught up, then there is a full return of capital. Once the capital is returned, only then performance split kicks in. So investors in Class A units get 80-20 split, 80% to investors, 20 to the manager as a performance fee, and a Class B 70-30. You can learn more about this fund by going to tempofunding.com/growth. And just a couple of words about our growth and income fund, Tampa Opportunity Fund. This fund is truly broadly diversified among many quadrants. We're mostly quadrant 1 and 2, but we have some quadrant 3 and 4. And we are focused on the best risk-adjusted return, while as much as we can, we'd love to stay in the investment grade quadrants for 1 and 2. So this fund is very opportunistic, and it mixes both income and growth strategy. Income strategy is about 2/3 of the fund, while growth strategy is about the income is 1/3, growth is income is 2/3, and growth is 1/3. So the target is 10 to 13, of which we target, obviously subject to the PPM and disclosures, to get investors 7 to 8% in distributions on annual basis, and then the rest in the form of appreciation, also on annual basis. So that's the target: 10 to 13, 2/3 income, 1/3 growth. It's broadly diversified. This fund is open-ended. Simply means we're raising capital on a quarterly basis, new subscriptions, redeem capital called redemptions, and then there are quarterly distributions as well. As I mentioned, 10 to 13% target, about 65% income and 35% growth, plus minus a little bit. Also tax efficient, it does pass through depreciation, and some portion of the return comes on the back end in the form of capital gains. Also IRA friendly, we're not using leverage on the fund level, and there are 3 classes of units. So all classes earn 7% pref, it's also cumulative. And then above that, the performance split kicks in: 80-20 for Class A, 70-30 for Class B, and 60-40 for Class C. This fund does not have a concept of capital calls, nor does it return capital. Anytime there's a return of capital, it's called a redemption. And anytime there is a additional capital goes in, it's called subscription. That's how it operates. So the performance split kicks in immediately after the pref, because there is no return of capital concept. And if you'd like to learn more about this fund, please visit tempofunding.com/income. Please request private placement memorandums, as those are the only offering documents. Areas of investment. We are very broadly diversified among many dimensions of diversification. Again, performing in distressed debt. Typically, when we invest in debt, our target is 16% plus IRR, but it mixes up. If the deals are less aggressive, more conservative, lower target may be justified. If the deal has some more risk, then we need to target a higher return, because we have to adjust for risk as well. So at the end of the day, we try to do the deals on a fund level. We try to deploy the capital with a target of 16% plus. On equity side, when we invest in value add and performing equity, we generally look at returns 20% plus. And we will absolutely look at strong cash flow syndications with the right risk-adjusted return in the high teens. But in general, we would love to get 20+% as a target. It varies, obviously, but it is a starting target. And the deals that have that are in quadrant 3 and 4, in my opinion, most of them need to have that target return 20% plus to have a great risk-adjusted return. Obviously, depends on the deal. Accountability, transparency, and audit. So we use Stoll Reeves as our SEC counsel. We use Verivest as a fund administrator for both funds. We are one of the Verivest verified fund management companies. And then for Tempo Opportunity Fund, we use our Manino LLP as the annual fund auditor. Appreciate your time. Hope you enjoyed this presentation. Feel free to reach out to us. The best way to reach out is go to bigmikefund.com or bigmikecall.com. There's another website which you could also go to called Talk to Big Mike. Schedule time to talk to our investor relations specialist and request PPM at your convenience. Appreciate your time and consideration. Have a great day.